Welcome, Tradition Mortgage. It is October 2025, and this is your compliance monthly training, understanding HPML, high cost loans, ATR, and QM. Just want to reiterate the importance of this training. Obviously, get it done within 5 business days. If you do not, you'll receive a reminder, friendly reminder that is, and if you do not have it done after the friendly reminder, then we will turn Encompass off. So please just knock these out ASAP so you can move on with your month and get some loans closed. So understanding HPML, high cost loans, ATR, and QM, this is a little bit thick, if you will, so just bear with me. Introduction, purpose, explain the significance of mortgage regulations. Overview, briefly introduce HPML, high cost loans, ATR, and QM. All right, what is HPML? Higher priced mortgage loans are typically defined as loans where an annual percentage rate, APR, exceeds a certain threshold above the average prime offer rate, which is obviously the APOR. For a comparable loan, these loans often come with stricter regulations to protect borrowers, including conforming HPML spread 1.5 or more above the APOR. Jumbo HPML spread is 2.5 or more above the APOR. Ability to repay, lenders obviously must ensure borrowers can afford their loans. Escrow requirements, escrows for property taxes and insurance are always required for all HPML loans, regardless of the LTV. Higher disclosure standards, lenders must provide more detailed disclosures about loan terms and costs. Appraisal requirements. A full appraisal must be completed with all HPML mortgages. Additional appraisal is required if the price reflected in the consumer's purchase agreement is a certain amount higher than the seller's acquisition price. More than 10% price increase if the seller acquired the property in the last 90 days, or more than 20% increase if the seller acquired the property in the past 91 to 180 days. HPMLs may be seen as riskier both for borrowers and lenders and often come with higher interest rates. Borrowers considering these loans should carefully review the terms and assess their ability to manage the payments. Always check your Mavent as a reminder. We'll tell you all. What are high-cost loans? They are defined under the Home Ownership and Equity Protection Act and generally include loans with terms that exceed certain thresholds, including APR. Points and fees, they cannot exceed 5% of the total loan. First lien cover transaction, this gets into the nitty-gritty. I'll go over it briefly. 2.25 percentage points, loan over 130, 464, 3.5 for loans of between 78 and 277, 130, 461. Subordinate lien coverage transactions, 3.5 for 78, 277, 6.5 for loans under 78,000, 277, which we don't see often or at all, hardly. These loans are subject to additional regulations to protect borrowers, such as ability to repay, which we covered, restrictions on prepayment penalties. These may be limited or prohibited, which most are. Additional disclosures, lenders must provide specific disclosures about the loan's cost and terms. High-cost loans can carry higher risk for borrowers, obviously, and lenders. Crucial to fully understand the terms and potential implications before proceeding. ATR, ability to repay. I mean, it is kind of what it says it is. Borrowers' capacity to meet their debt obligations. This assessment is crucial in lending as it helps lenders determine the risk of extending credit. Factors influencing this ability include types of income, employment, Schedule K-1, retirement, rental, dividend interest, alimony, child support, trust income, credit history, strong payment history, a good credit score, low credit utilization, minimal recent credit inquiries, the standards, negative marks like bankruptcies, charge-offs, collections, essentially assessing your overall financial responsibility. Debt to income, employment stability, assets, savings, investments, 401ks. You guys are pros, you know all about that. Qualified mortgages are loans that meet specific criteria established by the Consumer Financial Protection Bureau, CFPB, to ensure that the borrowers have the ability to repay. Goal of the QMs is to provide greater consumer protections and reduce the risk of default. Key features of qualified mortgages include ability to repay, limit on fees. Points and fees must not exceed 3% of the loan amount for loans above a certain threshold. Loan terms, QMs generally have a maximum loan term of 30 years. It cannot include risky features like interest-only payments or negative amortization. Debt to income, DTI limit is 43%. No prepayment penalties. QMs provide a safer option for borrowers as they are designed to reduce the chances of financial distress. However, they may also come with stricter qualification requirements compared to non-QM loans. The CFPB amended the QM rule in December 2020, which became effective October 2022. Price-based limit, which replaced the 43% ratio limit with a price-based limit. The new limit is called APR limitation, which states that the loan's annual percentage rate cannot be more than 2.25 percentage points higher than the average prime offer rate of a similar transaction. Removal of Appendix Q and any requirement to use it for general QM loans. Appendix Q was originally modeled after FHA insurance underwriting manual, but the CFPB found that some provisions were not suitable as regulatory requirements. Relationship between these concepts, HPML and high-cost loans, both indicate higher risk loans but differ in regulatory definitions. ATR and QM both focus on ensuring responsible lending practices, enhancing borrower protection. Regulatory implications, impact on lenders, obviously increased scrutiny and regulatory requirements for HPML and high-cost loans. Impact on borrowers, greater protection and clear understanding of loan terms, which obviously is great for them because it does get a little dicey. Final quiz, you know the deal. 4 questions, 4 right answers, hopefully. You can take the quiz as many times as you want. You can watch and listen to my beautiful voice as many times as you want. Important thing is, get it done, please. 5 business days after I send this out, which probably will be later today or tomorrow. I'll give you the 5 days. I can track these pretty easily. I have a spreadsheet I keep updated. I have important people within the company ask me who has completed these and who hasn't. So if it's not me telling you, it's Hendy telling you. Please get these done. It is very important. It's for educational purposes, and again for an overall compliance management system. So I appreciate you. I take the time to put these together. So please take the time to review it. Get the quiz done. No harm, no foul. Appreciate it. Thank you, guys.